Imagine you're a kid with a lemonade stand. Your parents ask how much money you made. You tell them 50 bucks. But here's the trick. You didn't actually make 50, you made 10. The other 40, that's what you think you'll make tomorrow, maybe next week, possibly never. Your parents believe you. They're proud. They tell the neighbors. The neighbors invest in your lemonade empire. And for a while, everyone's happy. Until someone asks to see the actual cash. That's Enron. Except instead of lemonade, it was energy. And instead of 50 bucks, it was billions. Let's go back to 1985. Houston, Texas. Two energy companies, InterNorth and Houston Natural Gas, decide to merge. It's a smart move. The energy market is changing fast. The government is loosening regulations. Suddenly, companies can trade energy like baseball cards. Buy it here, sell it there, pocket the difference. It's a gold rush, and everyone wants in. Ken Lay becomes the boss. He's charming, connected, friends with presidents. The company needs a name. They hire Paul Rand, the guy who designed the IBM logo. He comes back with Enron, sleek, modern, a little mysterious. The logo looks like it means business, and business is exactly what they're about to do. At first, Enron is just an energy company. Pipelines, natural gas, boring stuff that keeps lights on and homes warm. But Lay has bigger dreams. He doesn't want to just move energy around, he wants to trade it. So Enron opens a trading floor. Suddenly, they're not just an energy company, they're Wall Street with hard hats. Enter Jeffrey Skilling, sharp, aggressive, the kind of guy who thinks sleep is for people without ambition. In 1991, he takes charge of Enron's trading division, and he brings with him an idea that will change everything. It's called mark-to-market accounting. Here's how normal accounting works. You buy something for $10, you sell it for $15, you made $5. Simple, honest. But Skilling doesn't like simple. He wants Enron to record profits based on what they think something will be worth in the future. Not what it's worth today, not what they paid for it, what they believe, hope, or wildly guess it might become. The government says, okay, they approve it. And just like that, Enron can write its own report card. They sign a deal to build a power plant. Cost, $200 million. Expected profit over 20 years, maybe $1 billion. So right now, today, before they've laid a single brick, Enron books that $1 billion as profit. The stock price jumps. Executives get bonuses. Investors cheer. Nobody asks the obvious question, what if you're wrong? Spoiler, they were wrong. A lot. Throughout the 90s, Enron explodes. The stock price climbs $10, $20, $50, $90. Employees are getting rich on paper. The company is named one of the most innovative in America, 6 years in a row. Fortune magazine loves them. Business schools study them. Everyone wants to know the secret. The secret is lying. Enron starts investing in everything. Broadband internet, water treatment, even weather derivatives. Yes, you can bet on the weather. They're not just an energy company anymore. They're a trading company, a tech company, a whatever makes money company. Except most of these ventures don't make money. They lose it. Badly. But here's the magic trick. Every time Enron loses money on a project, they hide it. They create something called special purpose vehicles. Think of them as financial closets where you shove all your junk. These SPVs are technically separate companies, but they're funded with Enron stock. So if Enron goes down, the SPVs go down. But on paper, they look independent, clean, separate. It's like owing your friend $100, so you create a fake person named Steve. Steve borrows $100 from your friend, gives it to you, and now you don't owe anything. Steve does, except Steve doesn't exist, and your friend still wants their money back. Enron's doing this with billions, and the truly wild part? Their auditors are helping. Arthur Andersen, one of the biggest, most respected accounting firms in the world. They're supposed to be the referees. Instead, they're handing Enron the playbook and looking the other way. By the year 2000, Enron is flying. Stock price at $90. Revenue hits $100 billion, 30,000 employees. The company is massive, untouchable. Ken Lay is on magazine covers. Skilling is a Wall Street hero. Everything looks perfect. But underneath, the foundation is crumbling. Debt is piling up in those hidden SPVs. Projects are failing, cash is tight, and the lies are getting harder to maintain. A few people inside the company start asking questions. Whistleblowers send letters. Journalists start digging. And then the market shifts. The dot-com bubble bursts. Investors get nervous. They start actually reading financial statements instead of just watching stock prices go up. And what they find doesn't make sense. Enron's books are a maze. Complicated, confusing, intentionally obscure. The more people look, the less they understand, which is exactly the problem. Because when you can't explain how you're making money, people start wondering if you're making any money at all. February 2001. Ken Lay steps down as CEO. Jeffrey Skilling takes over. On the surface, it looks like a standard leadership transition. Veteran passes the torch to the rising star. Wall Street barely blinks. But internally, people notice something odd. Lay isn't retiring. He's staying on as chairman, which means he's still around, still watching, still very much involved. So why step aside now? The timing feels off. The company is supposedly thriving. Revenue is massive. The stock is strong. Why would Lay give up the CEO seat at the peak? Unless it's not the peak. Unless he knows something. Within weeks, cracks start showing. Analysts begin downgrading Enron's stock rating. Not aggressively, just subtle shifts. From strong buy to hold, from overweight to neutral, small moves. But in Wall Street language, they're screaming. The message is clear. Something doesn't add up. Investors start asking harder questions. Where exactly is this profit coming from? How are you valuing these assets? What's actually inside these special purpose vehicles? Enron's response? Trust us. We're complicated. You wouldn't understand. Which is corporate speak for please stop looking. But people keep looking. And the stock starts sliding. $90 in August 2000. By summer 2001, it's down to 40, half the value. Gone. Employees watch their retirement accounts shrink. Bonuses disappear. The vibe inside the company shifts from confidence to confusion. Then in August, Skilling quits, not retires, quits. After just 6 months as CEO. He gives vague reasons, personal, family, wants to spend more time doing literally anything else. The announcement comes out of nowhere. No warning, no succession plan, just gone. Wall Street panics. When a CEO bails that fast, it's never a good sign, especially when the company is supposedly fine. Ken Lay steps back in as CEO. Again, he goes on TV, gives interviews, says everything is under control, the fundamentals are strong, Enron is solid. Meanwhile, he's selling his own stock. Millions of dollars worth. Quietly, through preset trading plans that technically aren't insider trading but definitely feel like it. Employees can't sell. Their retirement accounts are locked during a plan administrator change. But executives? They're cashing out. By October, the walls are closing in. Enron announces its first quarterly loss in 4 years. $1 billion. They blame underperforming assets, write-downs, market conditions, standard corporate excuses. But buried in the announcement is something bigger. They're also unwinding some of those special purpose vehicles, the financial closets where they've been hiding debt. And when they open those closets, everything falls out. The SEC notices. They launch a formal investigation into Enron's accounting practices. Not a casual inquiry, a full investigation, subpoenas, document requests, the kind of attention no company wants. Enron's stock drops further, $30, $20. The company tries to calm investors. We're cooperating fully. We've done nothing wrong. This is routine, but nothing about this is routine. Then in November, the real bomb drops. Enron admits it overstated profits, not by a little, by $591 million over 4 years. They've been lying about their earnings since 1997. The entire growth story, the innovation, the success, half of it was fiction. Investors lose their minds, the stock craters, trading volume spikes. Everyone's trying to get out at once, but there aren't enough buyers, the price keeps falling. Meanwhile, something quietly devastating is happening to employees. Their 401k accounts, the retirement plans funded largely with Enron stock, are still locked. They can't sell, they can't move their money, they just have to watch as their life savings evaporate in real time. Over 20,000 people, trapped. While executives walked away rich, the company scrambles for a lifeline. They find one. Dynegy, a smaller energy competitor, agrees to buy Enron. It's a rescue merger. Dynegy will pay about $9 billion. Enron shareholders will take a massive loss, but at least the company survives. Employees keep their jobs. It's not ideal, but it's something, except Dynegy starts doing their due diligence. They look at Enron's books, the real books, and what they find is worse than anyone imagined. The debt isn't just high, it's hidden everywhere, structured in ways that make it almost impossible to track. Off-balance sheet, buried in subsidiaries, disguised as assets. Dynegy pulls out, deals off. We're not touching this. Enron is alone. Stock price hits rock bottom, 26 cents, down from $90 less than 2 years ago. 99.7% loss, one of the fastest corporate collapses in history. On December 2, 2001, Enron files for bankruptcy. Biggest in American history at the time. 30,000 employees out of work. Pensions gone. Shareholders wiped out. And the executives who saw it coming? Most of them are fine. They sold early, got out clean. The scandal doesn't end with Enron. It spreads because Arthur Andersen, the accounting firm that was supposed to catch this, they didn't just miss it, they helped build it. Arthur Andersen wasn't some small regional firm. They were one of the big 5 accounting giants. Trusted, established, the kind of firm that gave credibility just by having their name on your audit report. If Andersen signed off on your books, investors believed you. Banks lent to you. Regulators left you alone. That signature meant something until it didn't. Andersen had been Enron's auditor for 16 years. They reviewed every financial statement, every quarterly report, every annual filing. They knew the special purpose vehicles existed. They knew about the mark-to-market accounting. They saw the debt being shuffled off the balance sheet, and they approved it. Year after year, signature after signature, because Enron wasn't just a client, they were a cash cow. Andersen made $52 million a year from Enron, half of that from auditing, the other half from consulting services, advising the same company they were supposed to be independently monitoring. Conflict of interest doesn't begin to cover it. When the SEC investigation started heating up, someone at Andersen made a decision: get rid of the evidence. In October 2001, while federal investigators were circling, Andersen employees began shredding documents. Tons of them. Emails deleted, hard drives wiped, paper records fed into industrial shredders for weeks. An internal memo went out. Destroy anything related to Enron that isn't absolutely essential. They knew what was coming, and they tried to erase their tracks. But you can't shred your way out of federal scrutiny. The SEC found out. So did the Justice Department. And suddenly, Andersen wasn't just Enron's accountant. They were co-conspirators. In March 2002, Andersen was indicted for obstruction of justice. The charge was simple. They deliberately destroyed documents relevant to a federal investigation. The firm denied criminal intent, said it was routine document retention policy. Nobody bought it. The trial lasted weeks. Prosecutors laid out the timeline, showed the emails, presented testimony from Andersen employees who'd been ordered to shred. The defense argued there was no conspiracy, just poor judgment, but the jury didn't need long. June 2002. Guilty. Arthur Andersen, one of the most respected names in accounting, convicted of a felony. The firm's auditing license was revoked. Without that, they couldn't operate. Clients fled immediately. Thousands of employees lost their jobs. An 89-year-old firm collapsed in months. Today, Andersen exists only as Accenture, their former consulting arm that split off just in time. Meanwhile, the criminal cases against Enron's executives moved forward. Ken Lay and Jeffrey Skilling were indicted in 2004, 39 counts between them. Fraud, conspiracy, insider trading, lying to investors, lying to regulators, lying to their own employees while selling stock and telling everyone else to hold. The trials began in 2006. Both pleaded not guilty. Both claimed they had no idea the company was built on lies. Skilling argued he relied on his team. Lay said he was misled by subordinates. The juries weren't convinced. Skilling was convicted on 19 counts, sentenced to 24 years in federal prison. He served 12 before being released in 2019. Lay was convicted on 10 counts, but he never saw the inside of a prison. He died of a heart attack in July 2006, weeks before sentencing. His conviction was vacated after his death. Legally, he died an innocent man. Other executives got similar treatment. Andrew Fastow, the CFO who built the special purpose vehicles, pleaded guilty, testified against Lay and Skilling, got 6 years, served 5. The victims got almost nothing. Shareholders filed lawsuits, sued the banks who enabled Enron, JP Morgan Chase, Citigroup, Credit Suisse. They eventually settled for over $7 billion, split between 1.5 million claimants. Most got pennies on the dollar, employees got even less. Their retirement accounts had been loaded with Enron stock. Worthless now, decades of savings gone. Some got small payouts from settlement funds, many got nothing at all. But Enron's real legacy wasn't the money lost, it was the laws that followed. Congress moved fast. By July 2002, the Sarbanes-Oxley Act was signed into law. It completely reshaped corporate governance, created the Public Company Accounting Oversight Board to monitor auditors, banned accounting firms from providing certain consulting services to audit clients, required CEOs and CFOs to personally certify financial statements. If the numbers were wrong, executives couldn't claim ignorance anymore. Their signatures meant accountability, prison time if they lied. The rules were strict, expensive to implement. Companies complained about compliance costs, but nobody wanted to be the next Enron. The scandal proved that even massive corporations could implode overnight, that auditors couldn't be trusted to police themselves, that executives would lie until the very end if it meant protecting their wealth. 20 years later, those lessons still hold. The regulations are still in place. And every time a company collapses under suspicious circumstances, people ask the same question. How much did they learn from Enron? The answer usually isn't comforting, because when the incentives are strong enough, someone will always find a way to cheat. The only question is how long until they get caught. Enron didn't just fail, it exposed how fragile trust really is, how easily entire systems can be gamed when the people in charge decide rules don't apply to them. Thousands lost everything because a handful of executives chose greed over honesty. And the wildest part, most of them saw it coming. They knew the house of cards was falling. They just made sure they got out first. Today, Enron is a case study, a warning, a reminder that no company is too big to collapse when the foundation is built on lies. The regulations that followed made it harder to cheat, but they didn't make it impossible. Because as long as there's money to be made and consequences to avoid, someone will try. They'll just get better at hiding it. So the next time a company's growth seems too perfect, their profits too consistent, their explanations too complicated, ask the simple questions. Where's the money actually coming from? Can you explain this without 10 layers of jargon? And if the answer sounds like trust us, remember what happened when people trusted Enron.